Okay, good morning everyone. Today I'm going to be talking about the Royal Commission and the recommendations that were handed down. If these recommendations are implemented in full, as one side of politics is currently promising, then the mortgage broking sector will be dead, basically. 17,000 mortgage broking businesses, 26,000 support staff, thousands of other supporting businesses would be out of business effectively if this goes through. But more importantly, it'll mean drastically less competition and significantly higher costs for every single person who plans on borrowing money in the future. So the big banks would love to see an end to the mortgage broking sector, specifically Commonwealth Bank. And you can see that before mortgage brokers came onto the scene 30 years ago, the net interest margins that the banks were earning on home loans was significantly higher than it is today. And the reason for that is the increased level of competition in the home loan market in Australia today, and that competition can be put down to the effect of mortgage brokers providing everyone with access to more than just the couple of banks that might have branches in that particular person's town. Mortgage brokers, we write 60% of all home loans, so 60% as 59.1% in the September quarter. That's been increasing quarterly for the last 10 years. We have a 96% satisfaction rate, but this is the stat that I love the most. We write 60% of all loans, and we account for less than 0.5% of all complaints to the Ombudsman. So I think we're doing something right. But the Royal Commissioner has handed down recommendations that effectively puts us out of business without any consultation with the mortgage broking sector. It was an arbitrary decision. It didn't include factors like this. So it seems to be that the Commissioner has tried to find a problem that doesn't exist, and in solving that problem has broken the system. First, before we get to the Royal Commission recommendations, I want to go through a couple of myths that you'll constantly hear, and I'm constantly hearing as I'm tapping away at Facebook. Brokers earn secret commissions. Commissions are hidden in fine print. Nothing could be further from the truth. Commissions are comprehensively disclosed. In my particular situation, my business commission is disclosed on no less than 5 different occasions before we even submit an application. It's on the credit guide and privacy statement. It's in my lender commission schedule, which I provide as an appendix in my Pandanus plan to all of my clients. It's in my quote. It's in the credit proposal disclosure, clearly points out the amount of upfront and trail and how that amount is calculated. And even then, once the loan is approved and the bank issues the loan documents that you must sign and accept and return to the bank, those documents also disclose the commission that that bank will be paying to the mortgage broker. So this myth that brokers earn secret commissions or that it's hidden in the fine print is absolute nonsense. The second myth, brokers earn more commission on bigger loans, so push people into loans that are larger than they need. Well, the truth is that that is a problem that many of my clients would love to have. When I show them how much they can borrow and they said, can't we stretch that out? Can we borrow some more? So in most cases, especially if you think about first home buyers without a 20% deposit, they are already borrowing the absolute maximum that they can. But the reality is that it's actually incorrect, because we get paid a commission based on the net utilised funds. Right? So if you borrow $500,000 and you only needed $400,000, if that extra $100,000 is parked in an offset account or put back into your home loan, we only get paid commission on the $400,000 that you've actually used. So it's absolutely no benefit to us to recommend a larger loan than what you actually need, because there's no remuneration benefit for us. And that's something that we as an industry have imposed internally. So in consultations with the Combined Industry Forum and the Productivity Commission, with input from APRA, ASIC and all the industry bodies, this is something that as an industry we have implemented. It could have been a good recommendation of the Royal Commission, but it wasn't required because we'd already sorted it out. Tell you who does recommend that you borrow more money than you need? The banks. Because the more money you borrow, the lower your interest rate gets. Right? So if you're borrowing $220,000, the interest rate is going to be 4.86%. But if you just jumped it up to 250, your interest rate comes down by 30 basis points. So we're not recommending people borrow more money than they need. It's the bank's products that are recommending people borrow more money than they need because it's cheaper to borrow more money. Myth 3, because different banks pay different commissions, brokers stitch people up with the banks that pay them the most. This one's really frustrating because we could so easily get rid of this myth by making all banks pay exactly the same commission to all brokers. That'd just throw this myth out the window if everyone had to pay the same. And I think that will come in. But there's a few things that this says, and this myth says a lot more about the person saying it than who they're saying it about. First of all, there is very little difference between the commissions that the different lenders pay. So if you ask me what a particular lender pays commission, off the top of my head, I have no idea. I would have to go back to that commission schedule and find out. It doesn't factor into my recommendations to my clients because in reality, there's very little difference between the banks. It's also quite insulting to the intelligence of the average Australian borrower to assume that you would just sign the very first thing that the broker presents to you without doing your own due diligence, without realising, is this a good deal? Is this a low rate? Does it have the features that I require? So it's quite dismissive of the intelligence of Australian borrowers. But also what I think it does is it indicates a complete lack of understanding of small business, and it's a projection of that person's own personality. So, you know, they're basically saying that, you know, if you're in small business, you're out there to rip people off, right? You'll do whatever you can to make the most amount of money and screw the client. Well, I don't do any advertising. I do zero advertising. All of my business comes from repeat business or referral from my existing customers. How could they possibly recommend me if I was putting them into unsuitable loans that paid me a higher commission than what they could if they went to a loan that had a better features and better interest rate for them? Yeah. But it's also, I think, a projection of how they would act. They're basically saying, well, if I was in your position, that's what I would do. Right, so that's what the normal person would do. So if that person has a small business, I would suggest please don't support that small business because they're probably ripping you off. In reality, commissions are fully disclosed. The difference between them is minimal. And it would be completely gone if we had commission uniformity. Trail commission is money for nothing. So this is another thing that you'll hear, and actually this is what the CEO of Commonwealth Bank told the Royal Commissioner. He said trail commission is money for nothing, and the Commissioner has made his decision based on that conversation with probably the bank that did the most amount of wrong during the Royal Commission. In reality, after a loan settles, we keep working for the client. So we check in with them, we do annual reviews, we do pricing requests. If the client needs to fix the interest rate, change their loan product, set up direct debits, we manage all of that for them. But that's just sensible small business practice to look after your existing customers. We're not getting paid to do that. The reality is that trailing commission is actually a deferred upfront commission. So in the past, the banks paid 1.3 to 1.5% of the loan amount as an upfront commission to the broker. They then changed that many years ago, so they basically paid half of that at the beginning, and then they provided the remainder of that commission in chunks over the remaining years of the loan. The average loan in Australia lasts for 4 years, so if you have a look at the typical trail, the typical upfront and trail that most banks pay, we're still getting 1.3%, but we've got to wait 4 years to get it. Whereas if it's a total upfront commission, we get it all at the beginning. So trail is not money for nothing, it's a deferred upfront commission. And if it changes, if trail goes, then upfront commissions increase. But trail is a good thing for brokers because it smooths out our cash flow. In times where there's low levels of applications, we're still getting a residual amount of income through from the previous loans that we've written that allow us to pay our rent, pay our wages, and pay our tax.